Hi, everyone, and thank you for joining us for this third session of Strategic Tax Advisory Virtual Conference Series. My name is Lauren Stinson, and I'm a partner here at Cherry Beckert. This virtual conference features 4 sessions led by our Strategic Tax Advisory team, and we'll share our knowledge on best tax practices and how to utilize the latest tax credits and incentives to potentially benefit your organization. And this year, we're offering 4 different sessions in total, and we've got one more this afternoon. The next session will be later today at 1 o'clock Eastern. So we hope you can join us so we can continue to help your company leverage various federal and state credits and incentives to increase cash flow to meet financial objectives. So we hope you're planning to join us for the next session today. And on that note, I'm pleased to introduce our speakers today, Brian Dill, partner, and Lewis Cole, partner. So on with the show.
Thank you, Lauren. Appreciate it. And welcome everybody to today's discussion that we're going to be talking about pre and post transaction optimization. I hope that all of us get something really useful out of this session. We are going to be sending the documentation to everyone after the presentations are made. So look in your inbox for as these will show up automatically. My name is Lewis Cole. I'm the National Managing Partner with regard to state and local taxes. I've got a deep history in legal entity optimization, focused on the income franchise tax side, but more importantly, the integration of all of the planning for various companies. We used to call it planning back in the day, and that is not what it is anymore. It's absolutely optimization of integration of ideas and concepts and mergers and acquisitions. So this process that we're going to be talking about really dives into that. So that's myself. I'm out of Atlanta. And Lauren, how about an introduction?
Sure. So I'm Lauren Stinson. I'm also a partner in the state and local tax practice, and my focus is on sales tax. So my whole career has been helping clients navigate the murky waters of sales tax all the way from the foundation of Nexus all the way to the practical applications of filing tax returns.
Brian Dill.
Thanks, Lewis. I'm Brian Dill. I'm an international tax partner here at Cherry Beckert and head the group. On a transactions basis, I started my career on the transaction side and structuring deals, both from a structured finance perspective, acquisitions. So 30 plus years of doing that, and our group definitely handles all aspects of those transactions.
Kyle Nevin.
Hi, everyone. Kyle Nevins. I'm a partner in our transaction tax practice. We focus on buy-side and sell-side due diligence, as well as structuring, modeling, and other planning matters related to transactions. So happy to be here today.
Great. So let's start immediately with an opportunity to test your computer skills. How did you hear about this webinar today? Was it a Cherry Beckert advisory person? Was it an email? See if we can get everyone to participate. You have to answer 3 of the 4 questions to ensure that you get CPE credit. And as we talk about this, the entire presentation, we are going to be bouncing back and forth between all of us as we go through a particular area. We'll talk about it, and we'll talk about sales tax implications and the international tax. And then from a federal perspective, Kyle's going to keep us honest with regard to that. Okay, I don't know if we can close that, and we'll just run to the next slide. So as we go through we'll talk about the diligence process, and really the diligence process really has 2 pieces to it. It's the pre-planning strategy, and then you got the due diligence side. So pre-planning, there's still opportunities to determine if you if this is the right deal for you, what you're looking for. You can do it from the seller's perspective, that they want to go through the plan that they're going to sell their business and be as prepared as they can be. And then the due diligence side itself, asking all of those questions with regard to post-merger integration, looking if this is an opportunity for the company to determine what is the value that they're buying as they go through this. Integration and execution, most deals die because one of these two items does not work correctly. You have to plan it, you have to execute it. And then after the deal is done, we'll talk about post-merger integration and what opportunities are there 6 to 12 months after that. And Kyle, you are involved in a number of these types of deals. Does this ring true to you from the opportunities to be successful? What observations do you have?
Yeah, no, I think this lays it out really well. And I think if you look at kind of phase one and phase two, you're really looking at kind of the time frame leading up to and through the transaction, both from planning, how do you put the structure in place that's going to be most beneficial to the buyer post-closing, as well as understanding any kind of historical issues that may arise and may need to get remediated post-closing. And I think as you look at phase 3 through phase 5, it's really how do we take, our planning and implement that in a way that, not only creates value, but also creates for purpose of this conversation, an efficient tax function that can be used going forward and help integrate that into the buyer's existing tax function. So I think this lays it out very well.
Great. You mentioned value, and determining the value of a company can be completely related to how much preparation work. The amount of preparation on the front side will get you more value. Now, we're going to talk about most of this from a federal and a state and an international tax perspective. We understand there's a lot of other areas that we have and that we're going to be focused on as well that impact diligence, but really we're focused on the tax side of this. So as you go through that sales side pre-due diligence, talking with your clients or looking at it from your perspective, here are a number of different things that we find value. Let me go back. That we find value in order to determine the value of the company, to determine what issues are out there, and that you can, with enough time, remediate some of the issues that may be out. So reviewing your corporate structure that's in place, determining where the nexus is, not just state income tax or sales tax, but internationally. We'll talk about that as well. Being prepared from your compliance calendar for all of the taxes. They're going to want to discuss where you have nexus and compare that to your tax calendar. The structural simplification or rationalization, if you have enough time, you want to fix that on the front side of this transaction so that your structure matches the operations, and that any extraneous planning that you may have done in the past is off your legal entity structure chart. This has a lot to do with risk mitigation, of course, and doing this pre-diligence really is going to provide value to the overall organization as the sellers come in or the buyers come in and review all of this diligence. There's a lot of common due diligence issues that we have noted. And they're going to go into various categories, and each one of us will take a few of these and talk about. But isn't it interesting from a nexus perspective? In the past, we've worried about physical presence from our perspective. Now, with the states and things that have changed, it's the economic nexus that really matters. And we'll come to the permanent and establishment discussions in just a minute from an international. So let me focus on the income tax. Determining where you have nexus, looking at any unsupported intercompany transactions that you have, whether you've got the documentation associated with that. From a compliance perspective, have you filed the returns that you've got? And we see that a lot from an income tax perspective, especially when you compare it back to the trends for economic nexus out there. Old out-of-date planning. In a number of instances, I still see a lot the old Texas partnership play, and it's still in the corporate structure, and you can look at a structure and determine that. And pushing down debt. We see a lot of companies that have debt stranded, and again, we're going to focus on an opportunity with regard to that. So utilizing tax attributes and seeing that those are available. A lot of times what we see, credits and incentives were negotiated and no one captured that value. And so again, that will increase the value to the organization. Lauren, sales and use tax seems to be huge in due diligence and some of the biggest issues I see. How about yourself?
Yeah, you're absolutely right. I mean, it seems like every deal, sales tax is an issue that seems to come up, and they kind of all, all focus on some very common themes. The first one being nexus, and this has really been problematic in the post-Wayfair world. So, as we all know, 5 years ago, the Supreme Court issued the Wayfair judgment, and the world of nexus changed. And it's, even though we're 5 years later, economic nexus is still problematic, and as well physical nexus is still problematic. And what we're seeing is companies not really having a good grasp on their entire nexus footprint. From a physical perspective, not understanding what creates nexus. Huge issue post-COVID is now remote employees in all sorts of different all different states. And then some kind of trickier nexus creating activities like customer visits or having independent contractors perform services, subcontractors. So, really focusing on, nexus footprints. That's kind of the foundation of the problems that we see. And then we start getting into taxability. So, taxability, especially with like tech companies or service companies, taxability really gets tricky. Understanding if the state taxes that particular good or service, especially around software, information services, data processing. Is it a sale of technology, or is it a sale of or are you performing a technology enabled service? And a lot of times you have to get granular and look at contracts and really get to the granular details to understand the nature of the product or service that you're selling, so you can determine taxability. Then the other issue that we see a lot of problems with is exemption certificate management. So, going back to the sales tax 101, selling of tangible personal property or, taxable services are always taxable unless an exemption certificate has been collected from your customer. And, simply having a customer say that they are exempt is not enough. Companies need to have that documentation in hand, and missing those exemption certificates is a huge red flag in the due diligence world.
Brian, from an international perspective, give us your thoughts on common due diligence issues that you see.
Certainly, Louis. I think, if I could change the nomenclature here a little bit, I could put an X for international next to every one of these items, because I do think they carry over. When we talk big picture, purchase price and escrow, what do we see most common? Not to say it's in every situation, but I think just like you and Lauren on the Nexus side, with the new remote workforce, with the use of independent contractors without that determination being made as to whether they really are an independent contractor in a particular jurisdiction, even though a PEO may say it is. And then I think the other thing that's coming up is on VAT, a nexus, the place of supply rules. Should you be collecting VAT in a particular jurisdiction? And when that's 18 to 20% of a sales price, those add up very quickly. And the new thing, and the new kid on the block really, is the new digital services taxes. As we deliver services and activities more through the digital world, the new digital services taxes that we're seeing crop up on jurisdictions, even though the U.S. doesn't want them, is a new reality and should be evaluated through your due diligence.
Kyle, from a federal perspective, do you see purchase price reductions in one or more of these categories on a consistent basis?
Yeah, we're seeing these things come up on every deal. So I think, whether you're looking at income tax side and the sales and use tax or international, and as well as on the federal income tax side, these things are carrying over. They're relevant in whether it's a small deal or a large deal, and regardless of how complex it is, we're seeing at least one of these items pop up on pretty much every deal. And I think doing the due diligence and being able to get ahead of that pre-closing is certainly a significant value add that, I think everyone should be looking at when they're looking at a transaction. Because I think, as everyone here has alluded to, these dollar amounts can add up pretty quickly. and can certainly become very impactful to the deal valuation and to the purchase agreement analysis and considerations.
So with enough time in advance warning, and a lot of times you don't know that you're going to be selling your business, an opportunity just arises. I think collecting information associated with this, doing your own nexus reviews or having someone assist with that, determining what nexus issues are out there and doing voluntary disclosures. That seems to be, those two items seem to be the theme as we provide services with our clients, determining where you've got nexus, doing the voluntary disclosures, reduce that. It will bring more value to the overall organization. Seldom will you find an opportunity to do a big corporate restructuring on the front side of this. What they want to do is just understand and be prepared for all of the questions that are going to come. So with that, we would like to talk about your second polling question. Which of the following are common due diligence findings? Physical and economic nexus, failure to register and collect, transfer pricing, unsupported intercompany transactions not signed between legal entities, or the all you can eat, all of the above. I don't think there's a wrong answer to any of these questions. So get your CPE credit, make sure you're doing that. So as we talked about the first two parts of this being diligence, pre-diligence, and the next being the actual due diligence process itself, the next phases that we talk about really is planning your integration and then doing the execution. So not only planning it on paper and making sure you have the right support, but looking at it from the execution side. And things are typically categorized into, I'm sure you've heard these terms before, the day one readiness, and then the first 100 days, the 100-day plan. So we'll talk about that as we go through this. And Kyle, as the deals close and buyers plan to integrate the operations, what items and services do you see from a federal perspective and overall? I know it is not just tax, right? There's a lot of other opportunities on either side of this, and I'll throw that to you.
Yeah. So again, as Lewis mentioned, kind of, leading up to the transaction, typically, we're getting involved not just from a tax perspective, but also in other work streams as well. So I think, in the couple months leading up to the transaction, as prior to the integration that we're talking about, I think, we're getting involved oftentimes on the financial side, whether we're looking at doing a quality of earnings or some other type of financial analysis. We're really looking at the historical EBITDA and trying to understand how that impacts the value of the transaction itself. From a tax perspective, we're getting involved pre-closing on the due diligence, which we've talked about, as well as the transaction planning. In addition to that, we're also working pretty closely with the attorneys that are involved in the transaction on the structuring, as well as, to the extent you have a transaction that has any rep and warranty insurance or other things like that, we're typically getting involved there as well. And really just trying to make sure that we're identifying, the financial and tax here are really looking at historical risks and how we can, make sure that that's captured correctly in the transaction. And that tees up the integration, which we're going to get into here shortly. And the last point here on the right is just getting at some other kind of pre-closing diligence areas that we, are seeing come up a lot more often. I think are a big area of focus overall, particularly, whether we're looking at IT or cyber diligence, whether we're looking at, as we get to closing and, need to do the opening balance sheet or some valuation work, there's a lot of pieces here that fit in, which, while a lot of it's done pre-closing, it all kind of leads up to the closing and is a good segue into the integration. So I think all of these things are certainly very relevant and continue to stay relevant through closing as you get into the integration and the day one readiness.
That's exactly right. As we go through day one readiness, and that's one of the terms that's you'll hear commonly thrown around. You read in the newspaper that company A bought company B and it's effective today and the deal is closed. So what does it really mean to have day one readiness? There is a lot of work to be done, and it depends generally on if you're doing more work to be done before the deal even closes. If you're buying assets of a company or even having to stand up a new legal entity to house those, as opposed to the other side, which is if you bought the stock of a company and the company is just going to continue. Still a lot of discussion items, but more work to be done when you're dealing with an asset purchase. So having that plan, and sometimes there's not a lot of discussion, or they won't, the companies don't talk a ton. They don't communicate a lot on the front side getting ready. As it gets closer to the transaction, it looks like it's going to work. Then everybody realizes that there's opportunities and that we have to move very quickly to go to day one readiness. So let's think about it. You know, developing the corporate structure that's going to acquire the legal entity operations. Conducting meetings. This is a huge one. Conducting meetings across functional groups to find out on day one, if we're going to buy those assets, there's got to be a sales and use tax system that's going to be collecting sales tax starting day one in the new legal entity, or legal constraints or operational constraints or regulatory issues that if you buy a company and there were transfer issues, you have to go address those items and make sure that there's nothing that's going to prevent us from doing business starting tomorrow. Lauren, you know, as we set up the company to collect sales tax, and I keep saying that's a huge focus, because if we don't collect it, it becomes our liability, right? So from your perspective, day one, what are the critical items? And I know you're going to be talking about in more detail in a minute, critical items from your perspective for day one.
So critical is really understanding that high level, you know, where does the company need to be registered and collecting tax? So from a high level, that kind of overall nexus and taxability issue, to really the practical day-to-day administration of how you're going to, you know, carry on business. And it really does vary depending on whether it's an asset deal or a stock deal. And like you said, I'm going to be going into a little bit more detail on sales tax, but the crucial element is really to understand that, you know, no matter what type of deal it is, there is successor liability that needs to be understood and managed, because, you know, whatever past liability was, you know, for the target company, it now becomes the buyer's liability, and really understanding, you know, what all's involved and how to manage that.
Brian, what do you think about the international implications for being day one ready for VAT and GST and other items?
Yeah, Lewis, I think there's a few really large items dependent upon the type of acquisition. Certainly, if you're standing up a brand new company and acquiring assets or a business, you know, it's not like the US to get a new entity, to get the bank account, the anti-money laundering, to get the approvals. You know, that can take anywhere from 3 to 6 months. And that just might not align with the acquisition and the timeline. So what are you going to do in between? How are you going to operate? It is a critical decision that needs to be made. Number two, even if you buy an entity, and it depends, how is that entity going to function day one compared to how it did prior to? Maybe its sole thing now is to service the US group. Potentially, and I see this all the time, the company is not actually authorized to continue doing that type of business. And you have to change the charter and get that amended, get new business numbers. And then on the VAT side, you know, are you registered? Are you collecting? Do you have the right rating? Are you 0 rated? Are you getting your invoices out day one, ready to do that? Because as I said previously, that's 18 to 20% usually of the sales price. Are you collecting and remitting VAT appropriately? And are you getting the offset? It's not like in the US where you get an exemption certificate. You actually have to have input VAT and get the refunds or the offsets. Are you doing that correctly from day one? If you miss it, you don't have the invoices done correctly, you could be losing out on big dollars.
And you can tell from this chart, thank you, Brian, as you can tell from this chart that there are a lot of implications. And imagine, if you will, the fact that either we can utilize the entity that is still in existence to, for example, you know, the target legal entity continues to operate in its current form. In a stock transaction, absolutely it continues. From an asset purchase, it doesn't. And the question, the amount of day one items, if we're setting up a brand new legal entity to hold those assets or incorporating those assets into an existing legal entity, is going to dictate the amount of work that has to be done from the front side. So keep in mind, business licenses, again, all of these items are to keep the lights on, to keep the operations rolling, and you have to have a plan on the front side of this.
And Lewis,
yeah, go ahead.
Yeah,
Brian.
one of the things I was going to raise, and it was one of the questions that just came in about statute of limitations. I would add on the international side that there's a little bit different concept a lot of times. And simply because you do an asset deal, if the business comes over in totality, you buy the entire business, that statute of limitations, you might not have told the statute of limitation, and you may actually have an issue with prior tax attributes and tax exposures coming over in the deal. So it's important to not just transfer your knowledge of U.S. tax and business over into the foreign side, and you should focus on those things because those can crop up and surprise people.
Absolutely. Kyle, did you have any comments on this?
Yeah, I guess one thing I'll add is, I know we're talking a lot about, whether it's an equity purchase or an asset purchase. One thing to note, I think, for which a lot of people here probably already know, but just to be totally clear is, you could have a lot of instances where even though you're acquiring the equity of the business, it could be treated for tax purposes as an asset deal. So I think, generally speaking, that's not going to give rise to the same level of issues in terms of standing up a business that you may have if you're truly buying the assets of the business. But I think, you could have scenarios where even if you're buying the stock or buying the equity of the business, you could have it treated as an asset purchase and therefore give rise to, stepped up basis for tax purposes. So I think that's something to note here where, it's not always as simple as, are you buying equity or are you buying the assets? I think there's other layers that need to be peeled back there and looked at as part of the diligence and part of the integration efforts.
Absolutely. I see credits and incentives being a big deal, that sometimes you think you've got credits and incentives, but if the assets moved, even for those operations, for example, you may lose those credits and there may be a clawback provision associated with those. So lots of issues with regards to day one readiness. Then we come to the point of a 100-day plan. And it's called that 100-day plan because in an M&A integration plan, the first 100 days of post-merger are really critical for the long-term success of the plan. There are a number of companies that fail because of this page, the integration. Kyle, I know that you see a lot of deals going. Tell us about, from your perspective, how critical it is to have an effective 100-day plan and people that know what they're doing to help you through that process.
Yeah, no, I think it's very important. I think it's impactful whether you're looking at a small, add-on transaction, whether you're looking at something that is, more fulsome and really more of a complex type transaction as well. I think, while we're all tax focused here, I think there's so much overlay between the tax function and other functions within an organization, whether you're looking at finance, at legal, just the operations of the company, that, when you're talking about, do I need to register for sales tax? Do I need to create new entities? Obviously, all these things tend to overlap between the different functions of an organization. And I think, getting ahead of this and having this in place, when you get to closing so that you hit the ground running is certainly important. I think, the key points to that are just having good communication and really having a plan going into it where all the stakeholders are invested in it and are going to, not only strive to make it as efficient and value creative on the tax side, but make it as smoothly operationally run as possible as well.
And I'd say that post-merger integration, it's one thing to have a plan, and the second one is to execute that plan. And so to have a great plan and the wrong people or the wrong focus or management not pushing the integration is it's destined for at least lagging, if not failure. So I know that when these deals are announced, there's always synergies that they said that they want to achieve, and then management is accountable from that perspective. So keeping in mind as you go through this process that one of the things that you want to do is make sure that we have understood the synergies and that you plan to achieve those and measure those and quantify those as part of the process. Put those synergies, those opportunities in the right legal entity, that matters from the very beginning. A cross-functional team and communications among them from both legal entities, and having the right people. And what there has been a study or two that said that having just the executives only, as opposed to executives and the people underneath them, if you have the more people you have, and specifically those that are actually doing the function, not managing the function, you need them as well. Your chances of a successful integration go significantly up. We know we have Nexus reviews and all of that. You have to go back through and determine between the two legal entities, now what does our Nexus footprint look like? Does the structure match? Are there still savings? What's our new effective tax rate implications? A lot of synergies, a lot of issues, and a lot of reporting that people will have visibility to. We certainly want to make sure that we are considering those as we go through the integration part of this. So to keep rolling, Lauren, I'll turn these pages over to you.
Sure. So, polling question: how is your organization keeping up with sales and use tax obligations? We use the sales and use tax software. We do have an in-house team. We outsource it, or you're not sure.
Lauren, what do you normally see with companies dealing with sales and use tax, if you were to put those in categories?
Really a little bit of everything. It really, there's not a good one size fits all answer. It really depends on the unique nature of the company. There's a lot of companies that feel like, accounting resources are always in short supply. So a lot of times filing sales tax returns is not a, value added activity. So a lot of them make the choice to outsource.
That's great. So most have an in-house team.
Yeah. All right. And since sales tax is, so important post-acquisition, I want to talk to a few of the very important points that really need to be considered. And, the first one is Nexus. And I know I feel like a little bit of a broken record where I keep saying Nexus, 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 but that's really the foundation of which sales tax, lies. So really understanding the whole Nexus footprint. And then in the post-acquisition world, what has changed? So, whether you're doing, especially if you're doing a stock deal or really an asset deal or, any type of deal, how is that new entity going to impact the Nexus footprint of the whole company? So whether it is, if it's being rolled into an existing entity, how are those sales now going to impact the existing entity's Nexus footprint? It may be that, bundling on a whole lot of sales into new states will cross Nexus thresholds, the economic Nexus thresholds, quite a bit. It also, keeping it as an equity deal, there are some states that consider Nexus footprints or economic Nexus thresholds when you have to count related entities. So really looking at all the various different impacts that bringing that new entity on board to the entire org structure has. Also, what kind of services is the parent company doing for the new entity, or related companies, a sister company performing for that new entity? Wherever there's some crossover, there could be some Nexus impact. So, affiliate Nexus, where one company is performing services on behalf of another, will impact the Nexus footprint. Moving on to taxability, understanding, with a new acquisition, understanding the depth and breadth of all the services that they're offering in their Nexus states, making sure you've got a good understanding of what exactly needs to be taxed. And taxability really can be the Achilles heel of an organization. So, and once you go through the target acquisition, the Nexus analysis and taxability analysis, then it becomes, is there any exposure that needs to be cleaned up? So, I spoke to successor liability comes with every transaction. So if there's any exposure out there, it really does need to be remediated. Yeah, and then, kind of looking at some practical applications, reporting and compliance. If it's a stock acquisition, the sales tax accounts will, carry forward. But really important is, from a very practical perspective, can you access those online accounts? I've seen this be a really huge headache if it's not managed properly. So when you're getting that tax calendar, you're not only getting the username and password, but also emails and authentication codes, because the last thing you want to do is, to continue filing sales tax returns and realize nobody in the organization can actually get into the Department of Revenue website to actually file those returns and make those payments. Also, related parties, they need to be updated. The last thing the company wants is to have, any notices, audit notices going to the old company and that you're not aware of. So, just cleaning up kind of that reporting requirements. And then if it's an asset deal, you can close down the accounts and get the tax clearance letter to, just have a nice clean closure on that. And then finally, the technology piece. So a lot of companies do use tax engines, Vertex, Avalara, to make those tax determinations on a daily basis. So key questions is, do you have access? Do you need a new account? Do you need to link different ERP systems to new accounts? If you've got shopping carts, are they still mapped correctly? So there's a lot of pieces to consider just from the day-to-day practical applications of getting sales tax, integrated and correctly working. And then, of course, there's, just sales tax implications on the transaction itself. So as a general rule, every transfer of tangible personal property is generally subject to sales or use tax unless a statutory exclusion or exemption applies. Now, fortunately, in a lot of states, there are some different exemptions that will apply, like a bulk sale exemption or an occasional sale. And most of those states provide exemptions if all or substantially all of the assets of the business are sold. So, look to see, it's very important in this transaction to make sure that you don't have to pay sales tax on all the assets that are transferred. And then some other exemptions that may be applicable would be, sales for resale for inventory, machinery or R&D equipment exemptions. But one caveat, most states have some limitations on vehicles, watercraft, and aircraft. So not all assets are necessarily treated the same.
Great. And Brian Dill, international tax implications.
Yes, I would say, in the interest of time, I'm going to boil this down to 3 major points. Number one is transfer pricing. I'm sure you've heard the term, and it's about pricing between related parties and cross-border. But why? Why do you always hear it as, if you go through an IRS audit, why is it IDR number 1? When you go through due diligence, why is it the first thing everyone asks for? Because I hear from a lot of people that says, well, if I lose in one jurisdiction, I'll just claim a refund in the other jurisdiction. And unfortunately, that's not the way global transfer pricing works. In global transfer pricing, if you lose in one jurisdiction, you don't get the offset. And so what happens is you essentially pay double tax plus very high penalties. And that's why it's such a big deal. And the only way to get a refund is to go through a very complicated process called competent authority, which if you're not willing to spend at least 6 figures to go through competent authority, which are 2 governments talking to each other, and it can take years, it really is important to get your documentation set up and your pricing. I'd say number 2, what we see, and this is because the intangible value of most balance sheets today, that's the big deal, is the intangible value. And we see a lot of mid-cap companies, middle businesses go through do an acquisition, they'll do an equity acquisition, buy the stock of a foreign company, and have not thought through where they're going to deploy that IP or intangible value. I can tell you at least once a month, I have people tell me, I bought a UK company, but we're just going to use the IP back here in the US. Well, essentially what you've done is you've distributed the IP out of that UK company back to the US, and you're going to have to pay tax on that. And assuming it has zero basis, let's assume it was a $20 million acquisition that you paid for, you're going to have to pay tax in the UK on cap gain of $20 million. And at 23%, that's a big deal that you didn't plan for in your acquisition. So how are you going to use your IP post-acquisition? Where is it going to be deployed? Have you thought through those things? And I would say number three, if you don't have a lot of experience with international and compliance, get help. The penalties across the world are huge for non-compliance on the international side. In the US, those penalties usually run anywhere from $10,000 to $25,000 per form. If you don't fill them out right, they're incomplete, the IRS will issue penalties. So getting your compliance and reporting down and being ready to do that timely is also a big deal. So transfer pricing, IP placement, and compliance and reporting, I would say big picture in the interest of time, that's where I would focus my time from an international tax perspective. Louis?
Great. Thank you. And then the next thing that we look at, is from a state and local tax perspective is basically the choice of entity. As we acquire new assets and companies and try to stand those up, put them in either a new legal entity, or if you look through the corporate structure and there are changes made, there are 4 or 5 different options for types of legal entities, and that would be, and I'm going to go to this slide with sole proprietorship. So you can be a partnership. I continually see limited liability companies being utilized for the most part as they go through this because they're so flexible. Kyle, you do all of these transactions. What do you typically see from a choice of entity perspective?
Yeah, I mean, I think it's always fact dependent, right? I think it depends on what the current buyer structure is, and as well as how the acquisition is being structured. But I think, we do see a lot of LLCs given the flexibility. Obviously, if it's an all corporate type structure, you may see more corporations. And I think in the last couple of years, certainly seen more corps than we were seeing prior to that. But I'd say generally speaking, it's fact dependent, but I agree that there's a lot of LLCs being used due to the flexibility.
Yeah. And so as you go through the considerations here, we're a lot of us are state and local tax people. So the placement of acquired operations in the org chart, where does it go, and is it associated with and offset by losses that may be in another legal entity? And again, we're going to walk through an example in just a minute as we go through this process. Identification and quantification, and then a remediation of all of those entities or those issues that were identified in due diligence. We want to make sure that we clean those up as part of this process. Sorry, I keep pushing up one little button. And then combining those operations, getting the intercompany transactions in place, debt optimization. Again, we continually see debt stranded in a holding company somewhere, and there's almost no way to get that out without a lot of planning, and that generally is not done during the time of the transaction. That's generally done post-transaction. Instant unity things have to be considered, whether or not there's losses in one company and in another, and you determine if you need to be instantly unitary to take advantage of those losses and offset income. And then one of the key facts, things that really should be considered as we go through this process is, what's the ultimate exit strategy? Do they want to keep the stock basis that they've got in these various companies? Or, are they going to sell that, or are they going to sell the stock if there's an exit plan at the very top of the organization? And we don't care about the stock basis as we go down below. Typically, you care about that. And so after we've gone through this process of getting the company, getting it acquired, getting it integrated, and now we're operating, then the last thing that we do is really a post-implementation review of the structure. And So most of the times, people basically bolt on the structure, if you will. I call it just bolting it on. Put the company in, put it into the structure. Not much care from the taxability perspective or the tax efficiency of the overall organization. And typically, I've seen where it takes 4, 6, 18 months, depending on the size of the deal, to get these companies integrated. Kyle, as you look through these, and again, mid-market clients, I've dealt with a lot of the big ones, and it takes even 2 years to get these things integrated. How about from your perspective on integration of companies from a mid-market area?
Yeah, I mean, I think it's never going to be an overnight process. I think, generally speaking, it's going to take time to get it going. I think anything you do up front to help with that, and again, while we're focused on the tax piece here, I think the integration with other work streams throughout an organization is obviously critical. And I think, whether you're looking at a single entity that's being acquired, you're looking at a complex multinational structure, certainly going to present different challenges. And I think, we're seeing this more often on the bigger deals that have, cross-border considerations and multiple legal entities. But I think even on the smaller ones, there's still an appetite there to dig into this and try to figure out how to best position that entity within the buyer's overall structure.
Exactly. So after the company has been integrated for 12 to 24 months, again, most companies won't undertake this process. You want to then look at the overall organization and determine if there's an opportunity to focus on and create a leaner, flatter organization, which most companies want to have. It's cheaper to operate if it's leaner, if it's flatter, if it's got just the optimal number of legal entities in the corporate structure. And so undertaking this process, and various firms call it various things, it'll allow the company to evaluate that necessity of every legal entity and the tax efficiency from an overall, a global perspective. Review those operational changes and footprint that happened. Determine if there's any assets that are out there that are either not being identified, not being utilized appropriately, such as credits, incentives that may be stranded, NOLs that we have now generated over the past year. And then what you want to do is then discard, if there are assets that are going to be discarded. A lot of times people will buy all of the operations and they don't need subsidiaries number 2 and 3 anymore. They want to jettison those. And you have to think about this from an overall perspective, monetizing those credits and incentives, and then basically doing anything to impact and enhance the synergies that the company said that they were going to accumulate. Remember, I said before, it matters to management that they captured those. And if we can get an additional benefit from a state and local tax perspective, a planning perspective, permanent savings associated with those, it just enhances that. And apparently management likes that. And then planning the structure for the future of the organization, considering how your operations have changed, not really what we've done in the past, that's your history, but on the future, how we're going to operate as we continue to grow, and addressing your tax planning from that perspective. And some people would say that planning, is dead. I would tell you it is absolutely not dead, but there are a number of attributes that you have to look at and really analyze as you're doing planning. More of the planning is now done based on other than one-off strategies that may impact a state or two. The latest and greatest planning is to optimize your structure based on an operational perspective. When the audits come, and they certainly do, and they ask people from management or tax, and they say, well, does this structure really mean anything to you? And they say, no, that's a tax only thing. That's the worst answer you can find from that perspective, whether it's international, whether it's state. You want to have your operations be involved. Match those operations. Consider your key elements of what is the value of your organization. Procurement, supply chain items. Sure, management's in there as well. How do we make our money? Look at each of the revenue lines and identify, are they optimal from a state, from an income tax perspective? Document the non-tax business purpose. The last thing you want to see is a document that's floating around that says this is the state tax plan. That is not optimal either. We have seen states, I think North Carolina comes to mind immediately, that as they were reviewing the business purpose associated with your overall organization. And the plan, they said, you know, look at we'd like to see the sales document that whoever brought this idea to you gave you. And it started out with state tax and savings and, you know, dollar savings. And this is how we're not going to pay tax. That is not optimal. What you want to talk about are utilizing things like what's in a name, utilizing words like optimization and rationalization and go to market and adjusting your corporate structure to make sure that it matches the way that you really are operating, and tying it to something that management may have already talked about, that, you know, after the transaction, we want to then optimize and realign and all of that. That's what you want to do your legal entity optimization related to, not from a tax perspective. Don't let people give you a document that says that. Documents live on forever, specifically the electronic ones. And then you go through the process of reducing the number of legal entities and looking at the apportionment factors as you merge those together and you consolidate operations. That's where your planning really lies. Being optimal from an apportionment factor perspective, putting these companies together and utilizing flow-through entities and LLC to bring income and offset other operational items. Mergers are sometimes really good within the structure. Most companies need that legal entity for one reason or another. So again, conversion to an LLC would still matter. And then I tell you, if there's intercompany transactions, there has to be transfer pricing, whether they're international, whether it's domestic. You have to have the intercompany pricing, the transactions associated with that. So,
Louis?
Yes.
But I would just add a little color on the intercompany transactions. I would say when it comes to execution and implementation, the lack of what we see a lot of times is the number of topside entries, and getting yourself in trouble is probably disproportionate out there. And that I would highly recommend, you know, you incorporate this into your accounting system. What happens is you have trapped cash. What happens is you have underreporting of income, and it's gotten so bad on some that we've seen their foreign entities, the foreign government, the tax authorities have stopped them from doing business and not allowed them to do business. And if you don't think it's reality, and it doesn't even happen to big companies, you know, go back, I don't know, it's been about 10 years, go back to Weatherford. You know, they went through 3 CFOs, they went through 4 VPs of tax, they went through multiple financial restatements, all because they did topside entries and they didn't put in place their intercompany transactions.
Absolutely. And if you move cash to one legal entity, you have to think about how do we then move that up the chain back to centralized cash without creating some unanticipated issues.
Correct.
Yep. And I've seen before where a lot of firms, what the problem that they have is that the tax people are doing all the accounting entries and it's not in the system. So I think that that's the direction that you just mentioned as well. There are a lot of implications associated with doing planning and legal entities. And I think it's best that we go through this from this perspective. This is a client that we have been dealing with. That you don't need to know anything about the company other than reds or losses and greens or incomes. And this company really makes no money. They have 10 million of income and they have almost 10 million of losses that are stranded associated with that. And so a lot of items to consider as you go through this process. And what's interesting and what creates the biggest issue, and Kyle, I'm going to come to you with this. Interest expense I see it stranded at a holding company level instead of at the operational level, and they seem to be okay with that when the deal is being planned, until the fact that we realize that there's a lot of interest that is not being optimized from a state perspective. Any color with regard to the interest expense and the optimization issues that we see?
Yeah, I mean, I think, you know, it certainly is relevant. I think, you know, whether you're looking at just an entity that has U.S. operations only, or whether you're looking at an entity that has some foreign operations underneath the U.S. holding company, I think the opportunity to potentially do some debt push down is something that I think should always be getting considered up front. I think, you know, generally speaking, the debt's going to come in at the holding company level as kind of the guarantor in the structure. But I think generally speaking, it's It's something that is not always dug into up front. And I think as you start getting into the state and local considerations, compliance time certainly becomes more relevant. So anything that can be done up front to try to optimize that as much as possible is, I think, certainly an area that can be focused on more than it currently generally is.
I would tell you that from a state and local tax perspective, the words are, you want to be obligors on the debt, not just guarantors. And you want to be jointly and severally liable on the debt, and that you have to have the debt on the books of the subsidiaries. There are states that will say that's fine. You may still get it. The separate return states have the interest add back, and they disallow those interests even with intercompany transactions on outside debt unless you hit a number of specific items. And so what's interesting is that that's exactly what happened to this company. Company A was jointly and severally liable. But the two borrowers were the holding company and Company A. The company chose to put the debt at Company A, just the way it is. We walked into it, and you have all of this stranded interest, and they said, well, we'll just allocate the interest down. Allocation of interest is not doable for the most part. If for federal it works, for state it does not. And so as you go through this process, there are options available to you. Hey, we can just collapse all the legal entities and we'll offset, and we won't pay a dime of taxes. Nothing messes up planning more than facts. And one of the facts may be we need to have the stock of these legal entities continue. And so there's a lot of business changes when you convert companies and merge them together. We'll get back to sales tax again. Next thing is, go ahead, Lauren.
Hey, Lewis, I just want to be respectful of everyone's time. We still have one more polling question to go through. So why don't we launch that? Clearly, there's so much around, pre and post acquisitions that we can talk to, but we want to make sure we at least get to this poll.
Great. Now I'm just going to continue to talk very quickly. From this perspective, you can move certain operations in underneath that legal entity. And so we would not want to move the stock companies because they want to maintain the stock, but those that were acquired in an asset deal absolutely can be done. Again, a lot of implementation considerations associated with it. One of the other ones is you can do intercompany notes, but you have to have it where it matches the outside borrowings. And it's called the conduit exception, to make sure that if the money was actually used at the holding company level, but you booked it at Company A, you create a new intercompany note. That works. You have to make sure from the state's perspective that it really works. And then the last one is that to the extent that there's anything left over and we can't do that, planning still works from the perspective of having products and services and in various companies and pushing expenses through with valid notes, a valid operational agreement, a valid transfer pricing study, because the states and the federal and the international will ask you, do you have documentation associated with that? And they seem to ask that question right before they deny your deductibility. So from that perspective, I would tell you that I think we'll stop there and just say, we appreciate everyone listening. There's a lot of opportunity. There's a lot of value that can be generated with regard to this. And if you guys would like any assistance as you go through this process, find the right team. We believe we have it. We're very easy to work with. We've got a lot of Big Four experience, specifically, all of us. And more importantly, you'll see the same faces talking to you on the front side of this as you will as we go through that process of working. So look forward to talking to you. I hope you have a great day, and thank you all for attending.
Just one last note, please check the registration site linked in the chat if you want to attend the session this afternoon. It's 1 o'clock, and we're going to be covering the developing market for the purchase and sale of clean energy tax credits. It's fascinating. It's great tax planning. So hope you can join, and thanks, everybody.